Hey there, it's Bill with Smart Trades, and it's almost 7 p.m. Pacific Time, March 1st, a Tuesday, and I wanted to do a quick review and update of today's action and how things have played out over the last day or two. Um, Here's the S&P cash, and I had previously noted that this might be a wave one down. My alternate, which I had mentioned to my subscribers, is that it was possibly an irregular or expanded flat, and that one actually had ended on this previous pulse down, and that way it counts as A, B, C backup of wave two. Interesting to note, we went right back to the 1330 area, the area that I did not want to see this market get through. Um, I think if it got through there, it probably would have indicated that my count was incorrect. It's interesting also that we managed to just poke through there very briefly, intra-bar, intra-hour on the opening today, accompanied with a bearish breadth divergence. This is a recurring theme in my work, and a lot of folks use things like stochastics and MACD and RSI, and to be honest, I think that they're really inferior tools when you're looking at momentum, particularly when you're looking at the stock market, and you can actually look at the breadth indices. Why not do it? Um, on that note, there's a very good question that I had on YouTube here about breaking through the trend line on the advanced decline line. I had posted that in the last video. And here is the April-May peak last year. And you'll note we actually broke through the trend line twice, and um, and then actually, declined. Breadth ratios, you have to understand, are not going to trend the way that a regular market. They're basically, there's a finite number of advances and declines ranging from 0 to about 3,000 or so on the NYSE, and so they're going to bounce around in that range. Perhaps more importantly, if you get an extreme day, there's going to be a tendency for a lot of stocks. If you get any kind of an extreme decline, any kind of rally the next day is going to produce a relatively high number of advances, simply because the market, those stocks are up relative to that extreme close the previous day. It doesn't mean that they're up a lot. It just means that they're up relative to that close. So there are distortions. You have to be aware of that. You have to sort of think about what you're looking at. At any rate, note here, we did break through this trend line, and then we had the mini crash, and then we had the secondary crash after breaking well through that trend line on the advance ratio. But there was a negative breadth divergence on that retest. Also interesting to note, we basically tested the shelf that had formed at the peak on that secondary high, and before we went into that secondary decline, and notice again that bearish breadth divergence. Backing up just a little bit, very similar, we had that same kind of a shelf. We went up, we tested it, we had a bearish breadth divergence, and again, these patterns repeat again and again. This is the September low, and here again, this is when I first started talking about these channels that occur on the advance NYSE advances. And you'll note just after the low, we broke through the channel, and then we broke through it again, after the rally had started a bit. Nonetheless, that channel had been a good indicator that we were putting in a major low. And the fact that we broke through the channel briefly after the bottom is really not that important to my way of thinking. The important thing here is that we started this uptrend channel, and that was a bullish divergence relative to the price of the S&P 500. Now here's the current market, and again, here's that. This is a little bit dated. I actually did this for my clients. I believe it was a couple days ago. Anyway, you can see again we broke through the channel briefly here, as somebody had noted and asked, if that discounted the count of a top, and obviously the market has indeed rolled over since then. Crude oil, very interesting here to me. We're sort of at the near the midpoint of this longer term channel, or the top of the channel that started back towards the summertime. And with all the hubbub about crude, it still looks so corrective. I'll make the point that basically off of the lows back in early 2009, crude basically has rallied about 60%. On the other hand, unleaded gas has rallied from under a buck to over $3. Now, if you ever feel like you're getting ripped off at the pump, well, I've got news for you. You definitely are. This market has been totally manipulated higher. There's no way that crude oil is up 60% and unleaded gas is up 200% on pure supply and demand issues. This is, basically you've got some billionaires that want an extra $100 million in their pocket, and they don't mind watching the middle class go bankrupt in the process. It's just the way it is and the way it always has been. Another thing that I was browsing another publisher on YouTube, an Elliott Wave analyst that actually is doing research on Elliott Wave, and I found it quite remarkable that he counted this move off the November low in the dollar index. By the way, this is the cash dollar. He counted this as a 5-wave structure. I would just like to make the point that when you're doing Elliott Wave, the idea is to look for the most probable count first, not to impose your opinion on the market. I can't tell you how many times I see somebody basically comes up with an opinion and they're able to conscrew that whatever count they have is going to basically conform to their opinion rather than the reality of the actual wave structure. And here again, A, B, C, it's clear as a bell. He had counted this as 1, 2, 3. He counted this as a 4th wave decline. I suppose he's assuming it's a running correction. But again, the clearest and most obvious count for this rally is in ABC. Likewise, this rally here he counted as a 5-wave structure. It's just amazing to me that in the name of science somebody can say they're using Elliott Wave, but in fact they're really just taking their opinion, they're imposing it on the market, and then they're throwing an Elliott Wave label onto their opinion basically. Bottom line, I think it's very important when you're using Elliott Wave or you're watching somebody who's using Elliott Wave to see if in fact they're following just the most basic logic of pattern recognition. Again, ABC, it's there to see, and ABC again, and the implication is that in each case that the market was going to go down. Also of note here, if you look at around the 7850 area, the bottom of this first B wave, that's where the second ABC peaked, more or less. Oftentimes, this is what I call a B wave breakout. Oftentimes you will see that the market will remember a previous swing point, test it, and that will become yet another swing point. You'll notice that actually happened here too on a shorter term basis around this 7770 area of this smaller ABC. And finally, since we are talking about the dollar index, and I haven't talked about this in quite some time, here is the monthly cash, and I am far from certain about this count, but it is worth noting that a multi-year trend channel is looming just below the market. And my count, what I would prefer to count this as, is a contracting triangle. A, B, C, D. We've got E up, and then perhaps a drop to new lows below 70 or so, connecting to this very long-term excuse me, wedge channel at the bottom of this pattern. We'll take it one step at a time in this case, but it is worth noting that there could be major support here. And if it holds, I think it's important, and it probably bodes for a rally up to the 85 to 87 area. That's probably months away, so let's wait and see. It's also interesting that, if we do have a crash of 2012, that we may have a dollar decline into 2012 if this pattern holds true. Once again, I say this all the time, let's take it one step at a time. The important thing here, let's watch it as we get down to this channel. If it holds there, let's look for short-term low-risk patterns to trade into. Another note, that the dollar actually has been dropping here while the stock market has dropped sharply. This is in conflict to the very popular idea that we're going to have a massive deflation, and then that's going to accompany a stock market crash. I think that it's absolutely possible that it's actually going to work the other way around, that there's going to be an inflation problem that's going to cause problems for stocks. And perhaps the manipulation of gas prices will play into that. Who knows? I mean, that's beyond the scope of what I'm trying to predict here. I'm just looking for places to trade. And, probably the most important thing to go back and look at here, I'm going to scroll back to this chart of the S&P, is that it's quite possible that we have peaked. And if we have, and this is just wave one, and this is wave two, then this is probably yet another smaller degree wave one in a third wave down. So if we get a corrective rally back up and it fails below that 1332 area, you've got yourself a probable third of a third or the beginnings of a third wave in progress, and perhaps a very good place to get short. Hey, thanks so much for watching. Have a great evening. If you don't see this till tomorrow, enjoy your day. Bye.